Well, good day, traders. Chris Weston here, Head of Research at Pepperstone. Well, let's have a look at the week that was so we can use this as a platform, a foundation to sort of drive us into the new week. And as you can see here in the moves in G10, the pound's been the best performer, up 0.5%, which is something we haven't heard for a long time, to be honest. But certainly the dollar has outperformed most of G10, certainly against the Noki, which is with dollar Noki having the best performer in that complex, up 1.5%. But certainly the dollar's been helped by the fact that we've got higher CPI numbers relative to expectations and certainly a pretty strong retail sales number. But as we go into the week, we are watching what's happening in some of these indicators, such as where the Fed funds pricing is for the September meeting. And as you can see on my volatility chart in the top right, you can see what's being priced in terms of the September meeting and also what's being priced in across the swaps curve over the coming 12 months. So you can see in the Fed, for example, that 104 basis points or 4 rate cuts are being priced in over coming 12 months. We need to continue to assess, is that too aggressive? Is that underpricing? And I think, the US dollar may start being a bit more sensitive to that going forward. The fact is we've got a 143% chance of a rate cut in the September meeting, which effectively means 1 full rate cut's being priced in. There's a 43% chance of a 50 basis point cut. And that's going to be something that we are going to be assessing going forward. You can see the RBA there, 21% chance that we're going to get a rate cut in their September meeting. Of course, that's come down a little with that stronger labour market data we saw and also the stronger Q2 wage data that we saw as well. If you go into the middle of the page and have a looking at the G10 currencies, this is at the money implied volatility. So we're seeing that with a 61.8% level of confidence. Effectively, it's one standard deviation. But you can see here that in terms of what's more important to me is the sort of the percentage move. But it's the implied rank that I'm really interested here, and just to see whether these implied volatilities, which are looking ahead at all the data and all the event risk and everything that they expect to see influencing price, you can see it's actually not too bad. Yeah, it's been moving up a little bit, but you can see most of these G10 pairs are sort of sitting mid-rank in terms of where they've been over the last 12 months. So sort of sitting around that sort of 20 percentile. You can see cable there, which we've highlighted red, at the 20 percentile, even though they've got an at-the-money implied volatility at 7.48%, it's 20 percentile. So it's actually pretty low in the grand scheme of things. The ranking actually gives good context of where that implied volatility has been and the expected moves over the coming week. This is weekly implied vol. And you can see there, it's picked up a little bit from last week, but ultimately the market's looking ahead at the week that will be and saying, we're not seeing too much. Now, that's very different from the kind of implied volatilities we're seeing in the equity market, where if you look at mid-page, you can see the VIX index, which looks at the implied volatility over the 30 days, in coming 30 days in the S&P. Now, that sits at 21.18%. And more importantly as well, I think for FX markets, is what's happening in the implied volatility in the 30-year bond futures, which sits at the 100 percentile at 11.25%. Now, that's really interesting for me. If you want to understand what's happening in the euro, the yen, and the Swiss franc, these kind of counter-cyclical currencies, these safe haven currencies, they've been working very well when implied volatility in the rates market's picking up, and also implied volatility in the S&P's been picking up. It hasn't necessarily been picking up in FX markets, but the market, the FX market, has been using these currencies as a kind of hedge or a sort of speculative tool to counteract those moves that we've been seeing implied volatility. Have a look at the VIX. You can see it's sitting at 21%. Have a look at the daily chart there. You can see a move above 25%, and I think things get pretty real next week. I think if you're looking at that, a break of those 25% resistance level, and I think the world will look a pretty dark place and a pretty ugly place on the back of that. So what am I having a look at for the week that will be? There's not a lot of data. If I have a look at the US, we've got the FOMC minutes. I don't expect them to be a volatility event. Japan, there's not a lot of data. In Australia, we've got absolutely nothing really apart from the RBA minutes, which again, I don't think will be necessarily a volatility driver. If we have a look at Europe, it's more a focus on what's happening in the European banking sector, given the daily chart of the European stocks index, the stocks 50 financial sector looks absolutely awful. I think it's been getting sort of passed around the floors as to just what that actually means if we do get a break of the resistant support levels we've been seeing here. But I think as we go through the week, what is going to drive, well, apart from implied volatility in equity markets and also in the rates market, it's as we go into the back end of the week, we've got to have a look at this Jackson Hole Symposium. We've all become very, very clear fixed income experts. We've all been focused on the 210s curve. What is the message that they've been trying to say? Now, I think it's been more important for me, have a look at the difference between the 3-month US Treasury and also the 5-year forward rate. What does that mean in layman's terms? Well, the 5-year forward rate, as you can see here, is the long-term neutral rate set by the markets. Their anticipation of what the Fed funds should be and where it should be relative to their anticipation of where inflation expectations and growth and labour market situations are going to be. So the fact is that the ultra short-term rates, 3-month Treasury rates, risk-free, effectively are trading 54 basis points north of that long-term neutral rate. The market's saying that Fed policy is too tight. That is my clear precursor there, that Fed policy is too tight. And that's where we are seeing this inversion of the yield curve. We've also obviously seen clearer signs every day that we're seeing an end to this globalisation. Relationships are breaking down. And I think global growth's obviously been very much into consideration. The word recession has obviously been bandied around. The idea that we're seeing this ballooning pool of negative yielding debt, $16.7 trillion of all outstanding bonds have a negative yield, which is around 29.7% of all outstanding bonds have a negative yield. And as you can see from the chart here, gold's very correlated to that situation. I've also got two charts very closely on my mind, which I think is going to drive FX markets this week and also global markets more broadly. And one is the 5-year inflation swap level. This is the market's anticipation of where inflation will be going forward. The Fed do not want to see this falling. They need to get ahead of the curve. If inflation expectations are falling, that will breed lower inflation going forward. And that's something that will not sit well with them. If you have a look at financial conditions, they are also very cognizant that a deterioration in financial conditions, tighter financial conditions, will impact the real economy going forward. So as you can see from these two charts, we're seeing inflation expectations falling. We're now starting to see a breakdown in financial conditions, which will measure things like the S&P, implied volatility, funding rates, money market rates, and also credit spreads, amongst other things. And that's breaking down now as well. Now, as we go into the back end of the week, we are looking at what's happening in the Jackson Hole Symposium. The title of that meeting is the challenges to monetary policy. Now, that is an absolutely fitting title, considering as one of the reasons we have seen this big bid in long-term duration assets, 10-year, 30-year treasuries, Austrian bonds, is the idea that most people believe, or there's a growing skepticism to believe, that monetary policy will not actually be able to fulfill its role. So it's just so perfectly timed that we are getting this now with the flattening of the yield curves, the inversion of the yield curves, and people losing faith that monetary policy is actually going to be able to create inflation and drive steepening of the curve going forward. Who is going to be speaking from the Federal Reserve? That's really the question that I want to be seeing. I think the market wants to hear from Richard Clarida, the Vice Chair. That's the person they respect the most from the Federal Reserve. We've seen a communications faux pas from the likes of John Williams. The market's not sure whether Jerome Powell can actually communicate his message that clearly. Well, who's going to be speaking from the ECB contingent when so much of the European debt now is with a negative yield? The European banking sector looks terrible, and we've got a September meeting coming up where if they cut deposit rates even in deeper negative territory, what will that mean for the euro? What will it mean for the European banking sector? Will they be able to actually stimulate? Who's going to be speaking from the Bank of Japan? What will they be saying about future stimulus there as well when the JGB 10-year is actually trading outside of its range? And again, that's hurting their banking sector as well. So have a look at the volatility chart that I've set there. Have a look at the fact that we've kind of got low implied moves coming forward. But for me this week, it's also looking at the VIX, having a look at implied vol in rates markets and what that means for carry. Are we going to see a further unwind of those short carry positions there? And also what's happening in inflation expectations and the deterioration in financial conditions. That, I think, is going to be the key things for driving markets this week. But as we go into Jackson Hole, do be aware that people will be trading around the anticipation of that. And as we go into the weekend, there could be gapping risk for the Monday.